All right, it is a busy time in the what feels like typically a slow summer stretch for stock markets in North America, already trading at all-time highs. So we continue to watch the latest on trade, and there's a lot of moving parts on that front. We're now diving into earnings season, so we're going to get a taste of how corporations are navigating the trade uncertainty. And then there's the economic considerations. For example, inflation, especially with the trade war. A lot of people have been wondering about what the inflationary effects would be from that. So to get a new reading in the U.S. that arguably showed some softer inflation readings, that seems to be inspiring some investors, at least when it comes to the NASDAQ 100 futures contract and the S&P futures contract. But we also had some inflation numbers for Canada that, as I was mentioning, indicate there's a lesser likelihood that we'll see a rate cut at this next go-round for the Bank of Canada. I want to bring in Petursson, who's Chief Investment Strategist at IG Wealth Management, to talk about all of those moving parts in the markets. It's nice to see you.
Good to be here.
Can we start with the economic data on both sides of the U.S.-Canada border? Let's start with the U.S. because that's where we're already seeing a response there. Is that the correct thinking, that a softer inflation reading kind of leaves people feeling like rate cuts could be another positive for the markets later this year?
Exactly, and this is what we've been waiting for. We've been expecting the Federal Reserve to cut its federal funds rate at some point this year. It's just been a matter of when. We know it's going to happen, and Powell and team have been a little bit more cautious because they've been hesitant to cut rates in a tariff environment that hasn't been fully absorbed into the economy yet. The inflation rate that we're seeing right now doesn't fully reflect the tariffs, even from the post-Liberation Day kind of repeal, because companies, remember, kind of advanced the tariffs or got ahead of the tariffs by ordering more in the first quarter. So we're seeing those prices kind of flow through the economy. I think the real impact of the tariffs won't come until Q3, in which case, even then, we think there's only going to be a modest uptick in inflation in the United States, certainly within the range to allow the Federal Reserve to cut.
So I guess to have a follow-on question about trade, because it feels like, even though the headlines globally are constant confusion over trade policy, that the market seems to be just sort of parking their concern around trade. Do you think ultimately, if your goal is to see, the stock market higher by the end of the year, that you should be actually leaning into that market feeling right now?
I think you should. And I think you have to approach trade and the tariffs with a big grain of salt, in that, again, goes back to the old adage, take Trump seriously, but not literally. When he talks about tariffs, and now we've had a delay on the delay to August, and then Bessent comes out this morning and says, well, it's a flexible deadline with China. Yeah. So we get the sense that these trade tariff barriers, whatever you want to call them, are going to continue to be pushed out until we get some type of nominal deal for the U.S., similar to what we had with Vietnam, similar to what we had with the U.K.
And look, for Canada as well, I mean, you could make the argument that, and I'm not saying this is the takeaway from the latest inflation numbers in Canada, but I think the concern would be that there's a lot of inflationary risks for this country because of the trade uncertainty right now. What did you make of the fact that for the Canadian economy, there does seem to be a takeaway this morning that signs of inflation are going to keep the Bank of Canada from cutting interest rates, likely at their upcoming meeting?
Yeah, I think that's exactly the point. When we see inflation at 1.9% for Canada, which is within the Bank of Canada's range of 2% plus or minus 1, if you think about where the overnight rate is at 2.75, well, there's no justification to cut it further given 1.9% inflation, or inflation that we think is going to stick around too. So it's a different situation with the Bank of Canada than it is with the Fed. The Fed has room to cut. The Bank of Canada doesn't need to cut. And as long as economic growth and the labor market remain where they are now, which is okay, the Bank of Canada can hold firm.
And the Canadian stock market, as our audience likely knows, has been trading around an all-time high. The U.S. stock market has been trading around an all-time high. Coming into this year, there was sort of a big dialogue around geographically where people should be positioned. How are you thinking about broader stock market performance for the rest of this year?
We're more encouraged. We've gotten past the tariff tirade or tantrum, whatever you want to call it, of April. April opened up an attractive buying opportunity to add back into equities and set the stage to continue to add back, and that's what we've been doing. We've shifted from being defensive at the start of the year, being overweight fixed income, to now being modestly overweight equity, because when you think about where we are today and where we're going over the next 12 months, I continue to believe it's an environment that favors equity market performance. It favors earnings growth. And we'll get a better sense of that starting this week. But I think earnings are going to come in fairly solid, and guidance is actually going to be better than expected.
And what would that mean for, like, one of the big tech stories today, NVIDIA, which has already been, on this record run past a $4 trillion market cap, and it looks like they are going to be able to resume some AI chip sales to China, so a reversal of policy, continuing to fuel the hot hand. I think the technology companies are the ones that have the easiest time in showing profit growth. I guess it's profit growth versus expectations. So how close are you going to be watching the market reaction to the earnings from all the big technology companies? Again, big profit stories, but also big expectations.
Right, and that's going to be the thing. I think strong beats will be rewarded. Just meeting expectations or being slightly ahead will probably be punished. I think the market has set expectations high, and there are companies that will deliver. But what we've seen is a nuance in valuation. Valuation on some of these tech companies, take NVIDIA, for example, is much improved from where we were a year ago. And so if you have what I think is going to be strong earnings out of NVIDIA, this is a company that can continue to benefit. But others that are still fairly expensive, I think are going to be held back by the market. Overall, when you look at the S&P 500, the equal weight is far more reasonably priced than the market cap weight. And so I think we're going to get a broadening out where investors are going to take advantage of the cheaper valuations that can be found outside of the Mag 7.
Okay, so just before I let you go, so the S&P 500 itself is coming off a couple of years of gains of more than 20% and now is up about 7% for the year. The TSX, which had gains over the last couple of years that were lesser, but still notable, I think it was like 8 and 18%, and now the TSX is up 10% this year. This has been a nice run for the stock market. So if you're constructive on being long equities, but there are a few wild cards out there. Like, what do you think are reasonable expectations for investors over the next year?
Right. We're using the phrase boringly average.
Okay.
Right. I think that is what we should expect. Should we expect returns of 20%? No, I don't think so, because earnings growth isn't going to be in the upper teens or low 20% range. It's going to be in the upper single digit or low teens range for the U.S., for Canada, and international stocks. And then valuation is reasonable, but I wouldn't expect a continued multiple expansion going forward that would compound the gains on earnings growth. So the combination of very modest valuation gains but decent earnings growth is going to result in, again, that boringly average returns, which would be in that upper single digit range for our expectations over the next 12 months.
Okay.